Meta, Palantir, Tesla, Nvidia, the S&P 500, and the Nasdaq. I have six tickers right here that we're going to go through. We're going to break down what I feel like these companies and ETFs are going to do in 2026 with an exact price target by end of year of 2026 and how I think we're going to get there. And keep in mind, I don't think all these tickers are going to go up in 2026. I honestly think two of them are going to go down in 2026 and take a pretty big correction lower. So let's break it down and we're going to start off on Meta here. So let's look at the 5 year chart. You could see we're up roughly 126% in the last 5 years. Amazing run on Meta. They're making a lot of money. They're growing like crazy. But you could see if we go down to the 3 month chart that the stock is down quite a bit right here. And this is largely because of how they just reported Q3 earnings. The stock is down 17% since that. Basically, they were saying that they have more capital expenditures than what they were basically predicting before, and that's simply because they're building out their AI data centers. So if we head over to Gainify and we take a look at the estimates channel, we could take a look at CapEx, flip it to annual, and you could see just how much money Meta is planning on spending right now. 2024, they were spending roughly $38 billion, 2025, 70, 2026, 100, and 2027, 120. But there's a trend right here. From 26 to 27, the spending is going to slow down. And when that spending slows down, that's going to drop into earnings per share. So if we look at Gainify and you could see what they're projecting for earnings per share going out for the next couple years, solid earnings per share growth year after year after year. But I do think that this is kind of undershooting it a little bit. I do think earnings per share is actually going to be a little bit better simply because when they stop spending so much on these data centers and they start to reap the rewards from these data centers, that's going to go straight to the bottom line as earnings per share. And as you guys know, when earnings per share goes up, the stock price is typically going to follow that. But we do have to look at a couple more things here on Meta. Of course, I want to look at the revenue growth, which you could see pretty much going up and to the right. That's what we want to see. And the last thing that I want to look at on Meta is going to be the valuation level. Because even though we might have good revenue growth, good earnings per share growth, we have this tailwind for CapEx potentially slowing down eventually, we have to know that we're getting in at a good valuation level from the start. And if we just look at the PE ratio on a 5 year chart, you can see that Meta is trading at roughly 24 times forward earnings. So what that means is like Meta is not really fundamentally expensive at all right now. And if we just look at history going back 10 years, like the average PE ratio for Meta is somewhere around like 30ish, maybe a little bit higher than that. Now we're trading at 24. So we're getting in at a good valuation level, and I think that there's a lot of growth to come for this company. So it is a tailwind for them, and I think they're going to do very, very well. So Meta right now is trading at $623 per share. I am projecting for the end of year for 2026, Meta is going to be somewhere around $850 per share. So I think there's a lot of upside in this company. Now, we are going to have to talk about the S&P and the Nasdaq because if those go up more or go down more, it's going to affect my price prediction for this stuff right here. But I am projecting Meta is going to be somewhere around $850 per share by the end of 2026. All right, so let's do the big bad Palantir here. This one, you might get mad at me when I give you my price prediction for it. I'm just going to tell you what I think. I'm going to give you the logic behind it. You could comment below why you think I'm wrong. But 5 year chart starting out on Palantir, we could see that the stock, it made a very big move. It's pretty insane, to be honest with you. Up over 1100% in 5 years. The stock is on an absolute tear. If we go to a 1 month chart, you can see that since they reported earnings, kind of like Meta, they reported earnings and the stock is down. They're down roughly 14%. Why is this? Well, it's simply because people are just buying the rumor and selling the news. I mean, the stock, like, it ran up a lot. You got to give these things a little bit of a breather. It can't just go to the moon every single day. It has to take a little bit of a correction lower. All right, so let's head over to Gainify. We'll take a look at the fundamentals, the growth, the revenue, all that stuff on Palantir and the valuation, of course, to figure out where I think this company is going to go and my exact price prediction. And by the way, if you like Gainify, I don't like to promote things, but I do like Gainify a lot myself. Use code Brandon and then the number 10, Brandon 10. I'll put it on the screen right now. When you go sign up, you'll get 10% off. But let's head down to capital expenditures and see just how much money they're actually blowing right now. And you can see it's not really that much money. Like, yes, the growth is a lot, like 30 million, 40 million, 67 million. But as a percent of revenue, like they're bringing in billions of dollars of revenue, they're actually not really spending that much money in capital expenditures, which is honestly like pretty amazing. Like the growth that this company is providing here, the growth of revenue here, it's pretty good. I'm not going to lie. The growth is really good. And if we look over here at earnings per share, like, yes, they became profitable just a few years ago, but earnings per share for 2025, 72 cents, 98 cents, and $1.39. Like, it's good earnings per share growth, but it's not like we're going from $1 to $5 to $10. Like we're barely doubling from here to here. And that's a problem for a company that is trading at a valuation level of what this company's at right now. So if I scroll down, we'll go to the price earnings ratio level, we'll look at a couple other things, and you're going to see just how expensive this company is. So if I go to the right, you're going to see that they're trading at 242 times forward earnings, which is absolutely insane. Just compare that to Meta, where Meta was, way cheaper, like 10 times cheaper the valuation versus Palantir. And Meta has a little bit less growth, but it doesn't justify like paying 10 times more fundamentally for Palantir versus Meta, in my opinion. So, yes, it's definitely pointing to Palantir is definitely very expensive. If we head over to the PEG ratio, you're going to see that the PEG ratio is also very, very expensive. It's trading at 6x. So, basically, what that means is if earnings per share grows by 100%, the stock price is going up by 600%. And in the long run, the number one thing that moves the price of a stock in the long term is what the earnings per share does. So, yes, earnings per share growth, it's undeniably good at Palantir, but it's not going up as much as what the stock is going up. So, the stock is kind of becoming disconnected from the fundamentals. Again, amazing company. I'm not saying the company sucks. I'm just saying good company, not necessarily a good investment right now. So, what is my price prediction here? What do I think that Palantir is going to be at for the end of 2026? Right now, we're trading at 178 bucks per share, and I'm going to give you a conditional price target here. It's going to depend on what the S&P and the Nasdaq do. If these do good for 2026, I think the Palantir is going to end somewhere around 200 bucks per share. But if they don't do good, if we get a correction in the market where we go down 5, 10, 15, 20%, I do think the Palantir is going to end up potentially, 120 bucks per share simply because the stock is just so expensive right now. I know it doesn't look like the stock could go down. Trust me, like everyone's been making a lot of money, but it's disconnected from the fundamentals right now, and it is due to take a breather, especially if the overall market takes a dip. Let's dive into Tesla now. And I just listened to the Tesla Investor Day, and Elon's hyping everybody up about Robotaxi and Optimus and stuff like that. And, I agree, that stuff is going to be really big if it does come to market. But you could see that Tesla is up 207% in the last 5 years. Extreme amount of volatility here. I remember when I bought my shares of Tesla for like 150 bucks a share. I rode them up to almost 500. I rode them back down to almost like 100. It's been a very bumpy ride. And it's simply because investors don't know how to price the stock. They don't know how to value it because the whole valuation of Tesla, it's not built on what the business is doing right now. It's simply built on Optimus and the Robotaxi network, which hasn't really impacted the bottom line yet. So if we just go over to Gainify and we look at traditional valuation metrics on Tesla, it's going to be like, dude, this stock is completely out of control. It doesn't make sense to buy it right now. But it's simply because you're just pricing it in for the current earnings that the company's doing right now, not necessarily earnings from Robotaxi and the humanoid robot and stuff like that. So Tesla, kind of like Palantir, trading at 276 times forward earnings. The stock is very expensive. If we head over to the growth side, you can see that growth is going to be good, but is it going to justify, how much money you're paying for this company fundamentally? In my opinion, no. The stock, it's very expensive. Revenue growth is again solid, but it's not enough to justify the valuation level that you're paying. Earnings per share growth, yes, going from $1.65 to 226 to 327. Like, yes, solid earnings per share growth again, but it's still not enough to justify the share price right now. So, what is the move on Tesla? Well, it's going to be two-sided here. Like Tesla is going to bounce around with the market a lot. Just think of it as like a stock that has a high beta to whatever the Nasdaq is going to do, and whatever Elon says, and whatever the company does, whatever. But my point is, if you believe in the humanoid robot, and if you believe in the robotaxi network, if you could hold this stock for 5 to 10 years and you could stick through the volatility, you are going to do very, very well in Tesla, in my opinion. And that's what I'm doing with my shares right now. I'm not buying calls. I'm not selling puts. I'm not doing any option plays on this. I'm just simply holding it and being patient and riding through the volatility. I think you'll do very well if you could do that. Now, for the end of year 2026, I think that the stock is going to be somewhere around 500 bucks per share, simply because the valuation is hot. Robotaxi and the Cybercab is going to go into production next April, actually. So that's a tailwind for the company, and that's good. But it's not really going to materialize too much at the end of 2026, in my opinion. Tesla is more of a story of 2027, 2028, and 2030. So the stock is going to do great in those time frames, but for 2026, I'm stamping it at 500 bucks a share. All right, let's do Nvidia. This one is an absolute doozy here. And if we look at the chart, you're going to be like, "Oh, Brandon, it looks just like Palantir. It's up 1300% in 5 years." But guess what? there's a critical key difference between NVIDIA and Palantir. And we'll head over to Gainify. You could probably guess it. The actual fundamentals of NVIDIA are improving as the stock is going up in price. If we look at earnings per share, I'm going to scroll down in a second, flip it to annual. Look at this explosive earnings per share growth. It's actually pretty insane. 2024, a buck. 2025, almost three. 26, 4, 6, 8. It's almost doubling every 2 years, which is absolutely explosive growth. And it's kind of what the company is doing. Like the company is following what earnings per share is doing. Like if, this chart right here, it goes back 5 years, it goes back to 2021. The stock went up 1,300% since 2021. But what did the earnings per share do since 2021? We went from 25 cents a share to, roughly $4.53 per share. So earnings per share is absolutely exploding, and the stock is just simply following that. Let's flip to revenue growth. You could see it's expected to continue to just outperform year after year after year, explosive revenue growth. It's looking good for the company so far. And if we go to valuation, like let's see fundamentally how we value this company. I'm going to flip this through a 3-year PE ratio chart to get a better gauge of this. But right now, NVIDIA is trading at roughly 41 times forward earnings. A couple years ago, it was trading around 68 times forward earnings. Now it's a little bit lower. Like, is this company cheap right now? I think it's pretty close to intrinsic value. Basically, just you're paying fair value for it. Like the PE ratio is a little bit higher than what Meta is, for example, but this company is growing a lot faster than Meta, so it justifies the higher valuation level. Like at the end of the day, Nvidia is growing faster than Palantir. I think they're a better company than Palantir. I think they're more important than Palantir, and you're paying a way lower valuation level for it versus Palantir. So when you compare it like that, it's like, oh my God, Nvidia is so much better than the rest of these companies. To be honest with you, I am very bullish on Meta. Like Meta, I'm bullish on. Palantir, no. Tesla, hold it for a while. Nvidia, it's going to be good. And if I give you my 2026 price prediction for Nvidia, right now it's at roughly 190 a share. I think that the end of 2026 we're going to be at roughly 250 bucks a share, somewhere around there. And again, it's going to depend on what I say here for the S&P and the Nasdaq, because if the S&P and the Nasdaq take a big dip, and I'm going to tell you what I think it's going to do in a second, if these dip, all boats move with the tide. These dip, everything's probably going to go down with it. If these rip higher and euphoria stays in the market, these are probably all going to rip higher with it too. All right. So without further ado, let's do the things that basically set the trend for the market, which is the S&P and the Nasdaq. So we just take a look at this very simplistically. The S&P in the last 5 years, it's up roughly 89%. Did the earnings per share of the actual companies within the S&P 500 go up 89% in the last 5 years? The answer is no. We'll do the S&P and the Nasdaq together. So the answer is no to the S&P, so it's kind of pointing to, hey, maybe it is a little bit overvalued. Now for the Nasdaq, did the earnings per share go up 111% of the companies within the Nasdaq index? The answer is no again. So it implies that, kind of like Palantir, the indices are outrunning what the fundamentals are doing. The indices, the stock prices are going up faster than what the actual earnings per share are growing at. And if we just take a look at this chart over here, you could see that plotted on a PE ratio. So we have the S&P 500 is going to be the red line, and the IT version of the S&P 500 is going to be the blue line. So think of the blue line as the Nasdaq, think of the red line as, of course, the S&P. You can see that valuation levels are expanding. They're getting a little bit more expensive, and it's more so true for what's going on with the Nasdaq, which is, the blue line here. But there's key things that we could differentiate between right now and 1999 for the dot-com crash. Like the Nasdaq was trading somewhere around 55 times forward earnings, and right now we're somewhere around like 33-ish. So we're still not there yet, but we're definitely not cheap. Like this chart goes all the way back to like 1995. You know, we haven't seen a valuation level higher than this since the dot-com crash. Do I think we're in a bubble right now similar to this? No, like we're not there yet, but it is time to be a little bit cautious and be very, very careful out there. The market made a really big move. We have to be careful. Now the S&P, again, it's not as high as what it was during 1999 crash, but it is a little bit closer actually. Like you could see we're trading at roughly a 23 for the PE ratio, sometimes 24 depending on how we look at it. And back then it went to 25. So the S&P kind of looks a little bit more overvalued than the Nasdaq because this is farther away from the peak PE ratio level versus what the S&P was at. So just by looking at that, we could conclude that next year for the S&P and the Nasdaq, like maybe they are kind of priced in, maybe they are a little bit expensive, and maybe we should just simply expect a lot of volatility with those indices. And that's kind of good for us because that's going to give us opportunities to capitalize on stuff. If the Nasdaq or the S&P falls 20%, I'm going to be selling puts. I'm going to be buying calls. I'm going to be buying shares on that stuff. And things like Meta and things like Tesla and Nvidia and Palantir, those have a higher beta, more volatility than what these indices are going to do. So you're going to be able to capitalize on a bigger dip on those companies. So Meta's cheap right now, but if the overall index goes down, Meta's going to be even cheaper. So we're going to capitalize on it even more. All right, so let's get into the price predictions. So for the NASDAQ, let's start on that one. And I'm not going to tell you the actual price prediction because there's so many different ETFs to track this stuff, it gets confusing. I'm going to tell you what percent change I think the NASDAQ's going to do next year, and then we'll do the S&P. The NASDAQ, in my opinion, again, like we're having 20% years, year after year after year, like banger years when you average this together. I don't think 2026 is going to be a 20% year for the NASDAQ. I think it's going to be roughly flat for the NASDAQ. And meaning, if you look at my cursor on the tip of it, this is kind of like what I feel like the NASDAQ's going to do. Somewhere like, kind of bleed, go sideways, a little bit of volatility, and then trend back up. So I do think there's going to be like a mid-year buy the dip opportunity for the Nasdaq, and of course all the companies in the whole market overall because they're going to dip with it. I think there's going to be opportunity to capitalize. So don't have too much leverage in your account right now. Like be prepared to win on the upside, but also if we have some downside, be prepared to capitalize on that too. And the S&P, I pretty much think the exact same thing with that. Like not much in my expectation book for next year simply because the market already went up so much, valuations are a little bit stretched, and we just have to give it a little bit of time for valuations to simply just catch up to where the market's at. So I hope you got value from this video. So definitely like and subscribe. And of course, the jury is still out to see if my price predictions are correct. I feel pretty confident in them. We'll see what happens. See you guys in the next video.